Let's talk about the child tax credit. And the problem with the child tax credit is the potential exists for you to see three versions of this over the next few years. So the first version is the pre-Tax Cuts and Jobs Act. That's that Trump Act I keep talking about that took place in December of 27 that started in 2018. That version is scheduled to start again in 2026. The Tax Cuts and Jobs Act version was supposed to cover 2018 to 2025. And we've discussed that significant expansion of credit amounts and a reduction or elimination of exemptions. The phase outs all changed. They're much more liberal under this version of it. And then in 2021, Biden created his own version. It was in the House Reconciliation Bill, which snuck through really because of COVID. But in any event, that was an even bigger expansion of the child tax credit. That right now only covers 2021. They obviously didn't get the Build Back Better plan law passed in 2021. I'd like to think they wouldn't pass that retroactively at this point, but they could pass it for 2022 in 2022. But as it stands right now, for 2022, we're in the TCJA version. Okay, so let's talk about the TCJA version because that probably is the one you're going to see. We just don't know. So each taxpayer who claims a child as a dependent can take a credit, that's a tax credit, that's a dollar for dollar reduction of their tax for each child under age 17. So 17 or older doesn't qualify. And it comes in two parts, a refundable part and a non-refundable part. So first, the credit is $2,000 per child. So for each child you have, you wipe out $2,000 worth of your taxes. However, there is a phase out that starts at AGI of $40,000. And that's for married filing joint. For all other filing statuses, that phase out begins at $200,000. The refundable portion is the lesser of the amount of tax liability you have before the credit. So think of it as if you don't have any tax liability or you have very low tax liability, but you have a couple kids, the child tax credit is going to wipe out your entire tax liability, but it's not going to go beyond that. It's also the lesser of that or 15% of your earned income over $2,500. But in either instance of those first two, so the liability or the earned income limit, either one, it's limited to $1,400 per child. So it's never going to be more than $1,400 per child. All right. So there's no form required for the non-refundable child tax credit. It used to be that you filed a form 8812 to pick up the non-refundable part. The non-refundable part is the amount that's above your tax liability or that is above your earned income greater than $2,500. And if you have 3 or more kids, there's actually an additional refundable amount under TCJA. In 2021, you're actually required to file Form 8812. So that's unique. You only used to have to do it if you got the additional child tax credit. Now everyone's doing it. So, and technically it's Schedule 8812. But since most forms come with numbers, as opposed to like the ABC and 1, 2, 3, we default to form, but it's technically a schedule. Each child claimed must have a taxpayer ID by the due date of the return. You cannot then later get a tax ID, file a amended return, and reclaim that credit. If you claim a child tax credit erroneously, then you are not allowed to claim it for 2 years after that. And if it's considered fraud, I think it's 10 years. So it's much longer. So the idea is this is trying to defeat people who are claiming child tax credits that they didn't deserve. And if you do that, then you're not going to get it for a couple more years. Preparers are actually required to complete a checklist, a due diligence checklist that shows that they jump through the hoops to establish that that taxpayer deserves the child tax credit. That's not filed with a return, but it is kept by the preparer for their files that shows, it's documentation. Yeah, I did my due diligence. Refunds due to child tax credit are not issued until a few weeks after the IRS actually starts accepting returns. What happened is after they increased the child tax credit, a whole bunch of people filed fraudulent returns and got refunds right away for big money. Like, oh, I have 4 kids. I'm getting an $8,000 refund. And turns out that they were fake. And so the IRS now takes a little bit of extra time to review those early ones just to make sure they seem legit. All right, let's do an example. Fiona and Chris Everett, they're married. They file a joint return. They have 1 child. The child is age 13. So that means that they qualify, right? They all have a Social Security number. Their 2020 AGI, because remember, for 2021, it's a different set of rules, right? So we're using 2020 information. Their AGI is 409,800. So recall, there's a phase out. Let's go back and look at that, right? There's a phase out when AGI is 400,000 or more. So we're in a phase out. We actually get to look at how that phase out is calculated. So the maximum child credit is 2,000, but their AGI exceeds the threshold. The phase out amount is going to be $500. Let's see how that's calculated. So first we take the excess of their AGI over the total amount, and I have a typo. I guess it should have been 4091, not 4098. So 4091 minus 400,000 is 9,100. Then you divide that excess by 1,000. Then you round it up, always up. So 9,100 rounds to 10. Then you multiply 10 by $50, $50 for each 1,000. 500 is the amount of the phase out. Since they were eligible for $2,000, their phase out is $500. Their child tax credit before any limitations is $1,500. 2020, Bob and Michelle, married, filing joint. They have 2 qualified children. Their AGI is 72,000. Their tax liability before any credits is 1,043. So with 2 kids, we already know that they're going to use up their entire tax liability with the child tax credit. We're going to look and see if they get a refundable portion. So their child tax credit of 4,000 would be limited to their liability. Their liability is only 1,043. So that's going to drop it to 0. Now we have to see, do they get a refundable part? So that's in excess of their actual liability. Could they get money back just by filing their tax return? So they can claim the refundable portion of a child tax credit of $2,800. So let's see how we do that. Well, first we got to measure the lesser of. The unclaimed child tax credit, that was $2,957, right? That's the $4,000 less the amount they could claim, or 15% of earned income less $2,500. Well, their earned income, which was all, their AGI was all earned, was $72,000. Get rid of the $2,500. Multiply that by 15%, that's $10,425. Okay, the lesser of those two is $2,957. But remember, both of those are subject to the $1,400 per qualifying child. Well, they had 2 kids. That means it's limited to the $2,800. So they're actually going to get a refund above and beyond their tax liability of $2,800. There's also an other dependent credit. The other dependent credit is $500. So if you have any other dependent that you claim that doesn't qualify for the child tax credit, then you can claim the other dependent credit of $500. So Alex is a single taxpayer with a 15-year-old child. Alex also takes care of her elderly mother. So Alex would claim that he or she would claim the child tax credit of $2,000 and then an additional $500 credit for the mother. So this would apply, for example, for an 18-year-old child, right? So remember, you had to be under 17 to claim the child tax credit in the TCJA rules. And so an 18-year-old child, you would claim the $500. 23-year-old full-time student, you would claim the $500, et cetera, et cetera. All right, now let's look at 2021 only. So they expanded the child tax credit from $2,000, and they said, okay, if it's a child under the age of 6, it's up to $3,600, and if it's child aged 6 to 17, so remember that now includes age 17, whereas previously it did not. It's $3,000 per child. It's all refundable. The entire amount is refundable. So you can see this was a healthy expansion of the child tax credit. It has two parts, however. The original credit, that's the $2,000, and the additional credit, which is either $1,000 for a child age 6 to 17 or $1,600 if the child is under the age of 6. However, there are crazy phase outs for this. So the phase out for the additional credit is what you apply first. So as a reminder, the additional credit is the $1,000 or the $1,600. The additional credit is reduced $50 for each $1,000 above, and you can see the thresholds for married, filing joint, head of household, and all other taxpayers. So that means if your AGI is above those amounts, you would start to phase out the additional credit. However, that phase out is limited to the lesser of the increased credit amount, right? So it's not going to phase out more than the increased credit. So if you had $1,000 additional credit, but your income's too high, you just lose the $1,000. You don't lose more than the $1,000 yet. The $1,600, same one. Or 5% of the applicable phase out range as added by the American Rescue Act. Wow, you have to be kidding me. So the applicable phase out range is the range between the thresholds that now apply for the additional credit. So for married filing joint, $150,000. And the original thresholds, which are back here, $400,000 or $200,000 for all others. So that's considered to be the difference between those two. I can't believe they dreamt this up, right? But that's the applicable phase out range. And the reduction of that credit, that phase out, is limited to 5% of whatever that range is based on your AGI. Okay, there's only one way to do it, and that's through example. So Julie's had a household, AGI is $195,000, 3 children, 4, 10, and 12. So the child tax credit pre-phase out would be $3,600 for the 4-year-old, and then $3,000 each for the 10 and the 12-year-old. So that's a total of $9,600 of child tax credit. However, with AGI that high, we know there's going to be a problem. So her AGI exceeds the head of household threshold by $82,500. So the phase out would be, let's count it, like 82, round it up, divide by 1,000, that's 82.5, round up to 83 times 50, that's $4,150 of phase out before the limit. Let's calculate the limit. Well, the limit is first the additional amount, right? So what's the additional amount for her? It's 1,000 plus 1,000 plus 1,600. That's 3,600. Limit number 2 is, what is the amount of her threshold differential times 5%? Well, since she's had a household, it's 200,000 under the old rules minus the new rule 112.5 times 5%. That's 43.75. You take the lesser of those two, she's going to lose her entire additional credit. So none of her additional child tax credit, she's not eligible for any of it. So now we're back down to really $2,000 a child. The phase out's not over yet. Now we have to, we got another example. Well, I guess we'll get to the phase out on the other part shortly. Actually, there is no additional phase out. Why? Her AGI is 195. Remember, the old threshold is 200,000. Since she's not above 200,000, there's no additional phase out. As a result, she's going to take a $6,000 credit, $2,000 per child. All right, you can see Sally's had a household and her AGI is bumped over 200,000. So another iteration. Well, she's got 4 kids too. Wow, 4, 10, 12, and 14. I don't know how you could have 4 kids and be a single parent, but good on you, Sally. Okay, so let's calculate first her pre-phase out credit. 3,600 plus the 3 plus the 3 plus the 3, 12,006. Her AGI exceeds the threshold by 92.5. Round that up to 93 times 50. Her phase out would be 46.50 before the limit. Let's calculate the limit. Limit 1 is the total additional phase out amount. So 16 plus 1 plus 1 plus 1, that's 4,600. Or the difference in the thresholds times 5%, that's 4,375. In this case, the lesser of the two is limit number 2. So her phase out is limited to 4,375. So that means she's going to get 225 of the increased child tax credit, right? So that's the 4,600 minus the 4,375. That's 225. That doesn't mean that that's the total amount of child tax credit she gets. For that, we have to apply the old phase out rules. So now we would say, all right, well, as it stands right now, she's eligible for a child tax credit of $8,225. That's the total pre-phase out amount of $12,600 minus the phase out we just calculated of $4,375. That is subject to the old phase out. The old phase out started, recall, at $200,000. Well, her AGI is above it by $5,000. 5,000 divided by 1,000 is 5 times 50 is 250. So she has to phase out an additional 250. That brings her child tax credit down to $79.75. Okay, so let's pause here for just a second. That's a really complex calculation, isn't it? And I think there are two things that happen when, in more recent times, the Congress has passed and the IRS has permitted, if you will, but really, Congress has passed rules that are complicated like this. The first is there's a clear expectation that you are either using a paid professional or you're using software to file your tax returns, because it would only be under those auspices that this would make any sense to any reasonable human being. So what happens is the software does the bulk of the heavy lifting on the child tax credit. It did it in 2021. It'll do it again in 2022. So it's only if you're paper filing that you would have to go through all these complex calculations. And of course, there's a worksheet in the instructions that you can follow through. But, it's clear that we're shifting even our legislation to the point where we're really looking at this and saying, look, everyone's using a computer to do this. It can be complicated. It doesn't matter. So why do we need to learn it, right? Well, we really only need to learn it to some degree. So whether I'm going to task you with an exam question that makes you calculate the double phased out amount, that's not so important to me. What is important to me is that you understand the value of the child tax credit, about how much it is, and that you recognize that there are phase outs and when those phase outs begin, because that is something we need to understand for planning purposes, right? For planning purposes, I don't need to measure when Sally's 205,000 of AGI is over it. I would say, okay, Sally, how much do you think you're going to make this year? She's going to say, well, probably between 200, 210,000. I'm going to say, okay, well, you're probably going to lose part of the value of your child tax credit. So why don't we take a haircut off our estimate of the child tax credit that you're going to get of, somewhere around 4,400 if the old version if the 2021 gets extended. Or we'd say, like 250, 300 bucks for maybe even 500 bucks if you go up to 210 for the old credit. And we need to know that because that's 500 bucks, and 500 bucks is 500 bucks. And that's what we're paid to do. Okay. So in 2021 only, to make matters worse, the child tax credit could be paid to you in advance, and not worse for the taxpayer. Actually getting money in your pocket, that's kind of always a good thing, I guess. So what happened is in July, based on the IRS's estimate, they actually started sending you a check or a direct deposit if you claimed a child tax credit in 2020 or 2019. And so they tried to do their best in the estimate to, give you an amount that they thought represented more or less what your child tax credit was going to be in 2021. You could have gone to an online portal to elect out of it. That ship has sailed, of course, because 2021 is over. The Build Back Better bill did include advance payments of the child tax credit, so advance refunds, if you will. But again, it didn't pass. but it tells you that that is clearly part of the Democratic Congress and the president's overall plan is to try to make that credit get back into the pockets of people ahead of time. Okay, so if your advance payments are less than your child tax credit, you can always claim the additional credit, right? So if you know they give you $200 for the last 6 months and you get $1,200, and then you calculate your child tax credit and it was $2,000, you claim the additional $800. If your advance payments exceed your child tax credit, you would think that perhaps you would need to pay that back as some form of additional tax. That is not necessarily the case. So there's a bizarre safe harbor that's in place. So the first thing you do is calculate the safe harbor. Okay, so well, first you establish that your advance payments exceed your actual child tax credit. If that's not the case, you don't need to worry about any of this. But let's say there's an instance where you claimed the child last year, but you're divorced, and now the other spouse is claiming the child this year. Oh no, we got a problem because my actual child tax credit is going to be 0. So the safe harbor is take $2,000 and multiply it by the number of children considered in the advance payment, but were not part of the final child tax credit. So the IRS considered who was eligible for the advance payment, not you. So however many children they considered, you multiply that by 2,000. This only applies to you if your modified AGI does not exceed 60 for joint, 50 for head of household, 40 for any other taxpayer. Okay, so that means that let's take this example that we just did, right? So in 2020, let's say spouse A filed the child tax credit because they claimed the child as a dependent. So that means they got back half of that. So let's say they got back $1,000 in 2021, but they're not claiming the child in 2021 because the other spouse B is going to claim the child on a different return because they're divorced. Well, they would say, okay, the safe harbor is multiply 2,000 by the number of children considered for the advance payment. Well, the advance payment was considered for one child. Multiply that by 2,000. As long as the child tax credit I'm claiming is less than the additional amount, as long as the payments I received are less than the safe harbor, I don't have to pay any of it back. But that's only true if my AGI doesn't exceed 60, 50, or 40. Right? So if I'm reasonably affluent, that safe harbor doesn't apply. Amazingly, there is also a phase out for the safe harbor. So if my AGI is 61,000, right? It's not that I lose the safe harbor altogether. I have to start reducing the safe harbor by the ratio that AGI exceeds the threshold amount. You have to be kidding me. Nope, totally not kidding you. Howard claims 3 children. All of them were above age 5 on his 2020 tax return. In 2021, 2 of those are claimed by their mother. Howard did not report this change to the IRS. He wasn't required to, frankly. His 2021 AGI is less than 50,000, and the important thing about that is it's less than the phase-out threshold. That's the part we're keen on. So his estimated child tax credit for 2021 would have been 9,000. That's 3,000 times the 3 children. That means they're going to advance pay him half of that in the second half of 2021, or $4,500. But his actual child tax credit is only 3,000. Thus, his excess is 1,500. So you'd say to yourself, well, shouldn't he have to pay that back? Not necessarily. He had 2 excess children, right? 2 children that were part of the advanced payment that were not part of the final child tax credit, times 2,000, his safe harbor is 4,000. Since his income is below the threshold, 4,000 is more than the 1,500 extra advance payment, so he owes nothing. He owes nothing. All right, let's only change one thing. Howard's AGI is now 82,000. So everything's the same, right? His estimated child tax credit is 9. His advance payment's 4,500. His actual child tax credit is only 3. Thus, his excess is 1,500. His safe harbor is still 4,000. But in this case, his AGI exceeds the threshold. The head of household filing threshold is 50,000. He's over by 32,000. So we're going to take 32,000 divided by 50,000. That's 64%. We're going to multiply that by the safe harbor, 4,000. That's the amount of phase out that he's going to suffer. So his safe harbor was 4,000. It's now reduced by the phase out at 2,560. It's only 4,400. Since 4,400 is less than his excess advance payment of 1,500, he owes the government $60 of additional tax liability. So again, this is really complex, right? So from a planning perspective, you can see that this would be a pretty unique circumstance where, okay, we've got people who are flip-flopping who claims their dependents. That's almost exclusively what would be described as single-parent households, right, where the mother or the father don't live together, they're not married, and so they're debating who gets to claim the child that year. So they're agreeing to who gets to claim it, or divorced, right? Divorced parents that are flip-flopping back and forth between who gets it. So it's not that this is all that common. The good news is, yeah, you better believe it, the software does this calculation. So that was 10 slides. 10 slides on the child tax credit for a single year. Again, there were calls for extensions of this. They did not survive the legislative process. There were calls for this to remain fully refundable and include 17-year-olds. Permanently, again, did not survive the process.